We will begin by two presentations. The first speaker will be Dimitris Kyriakos, who is an economist and a member of the Greek party Syriza. The second paper will be by Nick Brooks, who is an economist, a trade union activist, and also a member of the Labour Party. We're going to be talking about the problem, mainly about the problem of sovereign debt in the peripheral countries of the Eurozone, and we will try also to find some concrete solutions for how to solve this problem. So,
we're going to swap places. You okay?
I don't think
you sure?
It's necessary, but
okay. Well, no, he's
whatever you two prefer.
That's what we were going to do originally.
Yeah.
But he's happy. Go.
Okay. Please, the floor is yours.
Well, I have prepared a speech for you about this problem that we're talking about, the banking sector and the debt problem.
Sorry to interrupt, but can you hear him?
Yeah.
Okay.
Well,
Okay.
well, the necessity of a public bank, this is my speech about. Well, first of all, we start with the importance of the banking system. The banking system was only deemed to be one of the most vital sectors for the economy to be able to function. Its importance as the lifeblood of economic activity, to collect deposits and provide credit to states and people, household and business inhospitable. In all economic systems, banks have the leading role in planning and implementing financial policy. The difference lies with prioritizing goals and their way of achieving them. Based on the neoliberal model, achieving greater profit by using all means is an end itself, while the socialistic system bank operation also aims at improving economy in general and at satisfying social needs. The financial crisis of 2008 and the way the governments choose to save the banks by laying the burden on taxpayer shoulders while exercising austerity policies triggered a cycle of discussion over many crucial issues. One of the basic questions was bank ownership, especially since banks were recapitalized using state money. The European leaders and institutional bodies have been promoting the idea of total privatization of the production means and state-owned enterprises among the bank sector, especially in the countries under memorandum obligation, such as in Greece, because, as they claim, the state cannot be a businessman and privatization will contribute in reducing the national debt. There is, however, a strong opposition claiming that state-owned enterprises, particularly those whose characteristic is monopolistic, and among these, the banks that were recapitalized using taxpayer money, must remain under state control because that's the only way for the economy to really recover and for the social leaders to be placed over the pursuit of profitability. In the following lines, I will try to prove that there is indeed need for at least one state bank, especially in the current demanding environment, and I will address the creation of a proper institutional framework to avoid phenomena similar to those of the recent past. First of all, a brief history, the role of the European leaders in this crisis. As a result of the outset of the crisis in 2008, due to the bank's exposure to particularly risky products that they were correctly described as toxic, the governments were faced with a very bizarre situation. The main characteristic of that situation was that no one could specify in all details the quantity of the money that would be required to put the economy back in balance. The solution that was chosen at the time was to support the banks with large amounts of capital, which would burden the annual deficits of the budget and ultimately the national debt and the taxpayers. As a result, the private debt was transferred to the state and became a public debt, which resulted in the explosive increase of the later, mainly Europe. The political leaders and the Commission officials saw in the particular occurrence a big opportunity to promote and implement their neoliberal agendas. In the small ledger countries, which has entered the support mechanism through memorandums, examples Greece, Portugal, Ireland, Cyprus, the particular policy was not received without tensions. From the aforementioned rescued cases, those of Ireland and Cyprus had to do with the banking sector, while Greece and Portugal problems were primarily fiscal. However, things were not exactly like that, especially for Greece, but I will address that matter shortly. Spain also received financial assistance to resolve its bank imbalances, but the country's size and its importance for the stability of the European structure kept it from signing a memorandum. It was deemed that signing a memorandum would cause political tensions, a potential fall of the government of Rajoy, Mr. Rajoy, and uncertainty for the future. Consequently, that would lead to a new European crisis. In this point, we must stress European irrational decision to impose bank bail-ins on Cyprus, which created an odd system for that country. Although the country is a part of the Eurozone, by enforcing the applied capital controls, in reality, it has been placed outside the Euro system. The European officials wanted to make clear that it was not a capricious solution, so they decided to promote this as a solution for any future bank rescues for the entire Eurozone, for the entire Europe. Naturally, this increased uncertainty, people withdraw their deposited capitals from the banks and liquidity became even tighter. As to the necessary unification of the banking sector in European level, and while the implementation of the respective fiscal unification is in progress, the idea of a banking union is blocked by the powerful countries, mostly Germany, which proves their intentions. At the same time, positive ideas such as the pan-European guarantee scheme of deposit, the extension of ESM role, the creation of a European debt agency, or even the partial debt pooling is not entirely dismissed. They have been postponed indefinitely. The second one, the role of the European Central Bank in this crisis. After the beginning of the crisis, the ECB's response could only be characterized as ineffective. Let us remind you that under Mr. Trichet's management, the ECB decided in 2008 to increase Euro key interest rates to maintain price stability. The onset of the crisis forced the ECB to change its position within a few months and to reduce the interest rates, but not as drastically as the circumstances called for. At the same time, the ECB bought bonds mostly from the regional countries like Greece, Italy, Spain, Portugal, to reduce the pressure of these country bond prices and bring yields down. The change in ECB leadership with Mr. Draghi being the new president is considered to have contributed to the change in ECB stance and to better and swifter response to the problems of the European economy. Up to this day, Draghi's whatever it takes statement in London is considered the main reason for Eurozone's rescue. Draghi's management main decision were the OMT, outright monetary transactions, and the LTRO, long-term refinancing operation for the banks. The first involved buying bonds from European countries under the conditionality term, and that this would sign binding agreements, memorandums, and ensure access to the markets. So, it is practically proven that by agreeing with the political leaders to maintain the policy of austerity as the sole solution for fiscal consolidation, for deficits and debt reduction, and for the recovery of the economy, the ECB, and for me this is a very important point, the ECB assumed a political role. As to the LTRO, the ECB preferred to provide commercial banks with liquidity without, however, setting any particular terms, hoping that this would offer more loans to the private sector. We still expect it for this. So, however, the data on the countries of the European region show that the loans to enterprises and to the household have been reduced, while interest rates remain high, which result in the reduction of competitiveness and a dramatic increase of bad loans. At the same time, the massive amounts of liquidity that have been injected worldwide by the central banks has a positive impact on state bond interest rates, and it caused a significant increase of stock valuations. However, Fed's recent decision on tapering its policy of quantitative easing caused serious problems to the developing countries, their currencies and bonds being the financial victims. At the same time, inflationary pressure increased after the rise of the prices of improved goods, mainly the raw materials for energy, oil, natural gas, etc., creating social problems to a large part of those countries' population. Under the current circumstances, the ECB continues to operate under the wait-and-see rule, despite the serious problems of credit crunch and high loan interest rates in the regional countries and deflation's appearance in the Eurozone, in the European economy, make some analysts talk of a Japanization of the Eurozone. Now, I'm going to talk about the Greek case, what happened in Greece. As we mentioned before, according to the official statements, the sole reason for signing the Greek memorandum was the country's bad fiscal situation. However, a thorough examination of the facts and the history of certain events revealed a different reality. First, the first decision to reinforce the banks was made in 2008, when then the Greek government was claiming that the crisis has not affected Greece. The manager of the Bank of Greece declared his faith in the country bank system, describing it as particularly strong, that it would meet the future challenges. The initial support package, in the form of cash, the issuance of bonds to exchangeable to premium shares and guarantees, was 28 billion euros. In current prices, Greece GDP in 2008 was 233 million euros. Therefore, in GDP terms, the help they provided reached the 12% of GDP. Thereafter, and up to the debt restructuring in March of 2012, the Greek state guaranteed the issuance of bonds for the banks for a total 155 billion euros. With the debt haircut in 2012 came the new support of 48 billion euros, despite the fact that the bank losses from the Greek bond portfolio reached 25 billion. If we sum all funds, the total bailout, with all the possible ways to the Greek bank system, exceeded 200 billion euros, or in GDP term was over 100%. Well, when the Bank of Greece and Troika divided the bank into systemic and non-systemic ones, on which three were totally private, Alpha Bank, Piraeus Bank and Eurobank, and in one of them the Greek state kept a minority percentage on all shares, National Bank of Greece. It was the biggest bank in Greece. Meanwhile, they decided to close two public banks, the Hellenic Post Bank and the Agricultural Bank. In Greek it's called Akrotiki, it's Agricultural Bank. because they forbade the Greek state to recapitalize them by its own means. Consequently, the two state bank institutions came to private hands. Then started the increase on the bank capital stocks under the term that the future privatization of the banks would be possible within 4.5 years, provided that the private sector will participate in the recapitalization process by at least 10%. In order to attract more participants from the private sector, they issued warrants, repurchase rights, with the exercise of which the bank will be gradually privatized. The particular warrants were freely offered, no cost, to those who participate in the capital increases. The free offer of warrants is a worldwide novelty. It was globally characterized as scandalous. Many newspapers abroad wrote about this scandal, that they gave the warrants with no cost, and it's something as a global paradox. Never saw that again. Remember, for example, 2008 in Barclays, when they issued warrants, that you have to pay something to buy the warrants. In Greek case, zero. As we speak, they have decided to change the legislative framework to expanded bank privatization by another eccentric procedure. The Greek Fund of Financial Stability is about to buy the free offered warrants and exchange them with its own common shares. Essentially, the shares will be given to private shareholders without them having paid just 1 cent. Not even a penny. Yesterday, it's something new, because Troika is in Greece and they have negotiation with the government, they decided to bring a new law for the bank recapitalization. They decided yesterday night. Well, if you wonder what the reaction is, let me say that the reactions are limited to the parliament control, to press releases, and to the public statement issued by the opposition, since no organized protest exists by the citizen against such a sell-out of the public property. Unfortunately, there are no social movements to attract the interest of the uniformed citizen and to impose different policies. The entire Greek system, all the government parties, bankers, business interests, media, wish for the aforementioned development, their goal being to perpetuate the existing situation because it quite simply benefits their interests. At the same time, the suggestion to create a bad bank under state control to resolve the bad loans, which increased almost amount to 80 billion, approximately 35% of the total loans of the bank, has been rejected because banks want to manage this loan themselves and sell them to funds, distressed hedge fund, vulture funds, etc., to ensure that there will be greater profits for them. But the social problem is growing and will keep it doing so as the forced sales of real estate are certain to intensify from the following year, 2015. Any similarity with promotion of respective action decision for the Slovenian banks should not be considered confidential. Let's go now to the institutional inventories for the banking sector. Before addressing the matter of banks under state control, we must see some of the institutional interventions that were made to ensure the bank sector normal operation. Ensuring the proper operation of banks must be first priority for all governments. The bank's role is to raise and safely keep the deposit of the household, of the businesses, and institutional organization, and to finance real economy. The banking system must be governed by a clear and austere legal and regulated framework. Investment banking should be explicitly distinguished from retail banking. As to the investment banks, specific limits must be set in risk-taking. Investment activities must be forbidden in retail banking. Moreover, special minimum limits of capital adequacy must be set for both types of banks. Monitoring mechanisms must exist and operate in national and international level. The rate of retail bank assets to the GDP of the country they operate in and the allowed market share must be specified. The phenomenon of 2008 with the banks that were too big to fail, and now they're bigger, which in the meantime became even bigger, must not be repeated. Creating a fund to guarantee deposits and abandoning the idea of bail-in would be a positive step towards restoring trust and reducing uncertainty throughout Europe. An increase of the available funds to the ESM would also be advisable through the creation of credit lines with the ECB in order for the bank recapitalization to be performed by that mechanism without any state interference. Debt pooling, even a partial one, would have a positive income. Combined with ESM's reinforced role, it will help break the dependence of potential bank bailouts and public debt. I will state much more institutional intervention, but I will stick to those for there's no time. Okay. So, there could be one answer to the questions of what should happen to the banks that have been recapitalized with taxpayer money. They should be placed under state control. Banks were under state ownership and control in Sweden during the 90s, while bank shares came to the hands of the state also in the USA, England, Spain, France, Belgium, Germany, and other countries. A state must have a say on whether or not banks could be under its ownership. It should not be forced into selling its banks by foreign factors. Governments should base their decision on the interests of their economy and society, rather than obey the neoliberal directions of the Commission officials or the leaders of the powerful countries. Let me note that the powerful countries choose for themselves different policies than those they impose, especially when it comes to reducing social expenses, controlling banks and other state enterprises, labor markets, taxation, etc. But what the experience from managing problems during crises such as the one we live for the last 4 years in Greece has shown is that there should be at least one public bank, and much more so, a very well organized and capital strong bank. Greece and other countries with similar banking problems have been against a serious public debate on finding alternative tools to fund the economy in order to restore its positive growth rate. However, as the world experience and representative literature have shown, only 25% of the economic recovery is creditless. Moreover, it has been proven that without adequate bank participation, growth momentum will decrease after the first 3 years. In today's uncertain situation, banks choose to deleverage balance sheets and manage bank loans over offering new loans, which result in less liquidity for the real economy, which in itself has serious economic and social effects. Business keep closing, private citizens fall bankrupt, unemployment increases, social problems intensify. Instead of wishing for and promoting the domestic bank or supranational organizations such as the ECB or the European Investment Bank, etc., to offer more grants, the solution bears only one name for me: public bank. Well, what a public bank must be. To begin with, public banks must not operate outside the total goal of a government development and economic policy. It It's something that Michael told us yesterday about that we need, every country will need a national plan for restructuring and reorganization of the economy. Well, the bank must have a leading role in the planned and applied economy policy, both in the total planning as in the financing of the real economy. In other words, the bank is a useful tool for exercising policy, not a means to replace it, as has been happening in the last years in Europe. The importance of a public bank increases in periods of recession and deflation, where conditions are created to reduce liquidity. Public banks should have the tools to limit the adverse effects of the above phenomena by providing low interest rate credits in order to set economy's mechanism back in motion. In several countries, mostly those in the Euro region, private banks seem to be unable to act as the economy's lifeblood. For that reason, most of the developed and underdeveloped countries for the world have started debating over the necessity to create a banking organism under state control. Even in the USA, the creation of state banks has found several supporters. The example of Bank of North Dakota, a depository bank based as the anonymous state of the USA, which offer low interest rate loans to students, small businesses and startups, cooperates with private bank in purchasing house loans and buys the state municipality bonds, has already become the center of discussion among the financial circles. Bank of North Dakota and its mode of operation is one of the basic reasons why the state of North Dakota shows the lowest level of unemployment and bankruptcies in the USA. They have an unemployment rate of 2.6. Let me note that public banks constitute 40% of the number of banks worldwide, most of them being in the developing countries, emerging countries. It is a coincidence in those countries, the impact of the recent crisis was much smaller. Is it coincidence that the greatest economic miracles only happened where governments had their own state banks? Germany, Brazil, Japan, Singapore, China are characteristic examples. In Europe, we see the creation of developed banks, with the recent example of France and Andalusia in Spain, who copied the success model of the German KfW. People must know that KfW and other developed banks and bank services institutions are exempt from the especially demanding standards of capital adequacy posed by the Basel standards, you know the standards of Basel. The question, would powerful Germany be showing us an alternative way, a solution to fund Europe's powerless economies? Returning to the issue of public banks, we must stress that this operation does not in any way focus on profitability, but on the satisfaction of development planning requirements and on meeting society needs. The bank's goal is to present profits in order to increase its available funds and return them to the governments to reinforce the expenses of the social state. Profitability is the means that amplifies the capacity of intervention, not the exclusive goal to satisfy its shareholders. The significant difference between a public and a private bank is the absolute transparency that governs the first operation. Everything from its statute, its bylaws, the code of corporate governance, to the investment tools and the limit of risk taking, etc., will be discussed with the society, the professional agency, and the trade unions. It is self-evident that such a bank operation must be legally established in order to avoid any misinterpretation and deviation from the intended purpose. Phenomenon of bad management, scandalous decision, official intervention, and free loans must be deterred with the use of institutional tools. Otherwise, there will be strong criticism for the banking establishment, trust will be shaken, and many citizens will demand the bank closing. At this point, I will transfer that the Greece experience will have been phenomena of mismanagement from the administration of state banks, which, as already mentioned to you, they are under privatization. At the same time, state must make the corresponding decision to allow promoting the idea of associated bank institution, which may have a particular role to play in the entire system. These banks could constitute the first cells of a different type of economy, especially locally, and in cooperation with a public bank, and with the use of appropriate tools, could contribute with the progress of specific industries, cooperate with and jointly liable business, achieving regional development. Well, refuting the arguments against the creation of a public bank. First one, public banks are systemically risky. In reality, it is just the opposite. It was the coordinated action of governments and central banks to rescue the financial institutions that were deemed too big to fail that saved the banking system from total bankruptcy in the USA and Europe. Indicatively, we must say that the USA gave the enormous amount of $16 trillion to keep the banking industry alive. But what was the main cause of the problems? It was the assumption of a huge investment risk by the purchase of securitized mortgage loans and derivatives that almost blew out the global system. The role of public banks must be explicit already from their statute. Their exclusive aim must be to fund domestic economy in clearer and more economic terms than those offered by private banking institutions. It is self-evident that they should not participate in profit-making, particularly investing in shares, derivatives, toxic products, as unfortunately happened in many cases before the crisis of 2008. At the same time, any funding they are offered must be a product of excessive study to avoid creating bubble conditions, for instance in the real estate market, and their internal procedures should be clear and strict to prevent their administration from giving loans under political pressure. It is also necessary for them to have democratic and totally transparent operation rules for the taxpayers to be able to be constantly informed on their administration activities. That would greatly help to limit taking not desirable risks and making of scandalous decisions that could endanger the operation of the public banks. The second one, public banks cannot compete with the corresponding private ones. First and foremost, all those who claim that public banks cannot compete with the private ones do not actually want any competition in their first place. Greece example is characteristic. Two public banks closed during the crisis, Hellenic Post Bank and Agricultural Bank, whose financial figures were much higher than those of the corresponding private banks that acquired them. It is worth mentioning that the Hellenic Post Bank received the third best rating in ECB's stress test in 2010 for the regulated capital score tier 1 entire European system. It was the third biggest rating. Despite all that, its participation as well as the participation of the Agricultural Bank in the procedure of the restructuring of Greek public debt caused serious problems to its operation. That caused a sensation was the fact that they chose to essentially give away the two public brands to private ones, which because of the distinction in good and bad ones, cost to the taxpayers more money than it would cost directly to capitalize them. So they divide the banks to good and bad ones, but the money they give to gap, to fill the gap between the asset and liability side, they use more money than if they recapitalize directly. Well, moreover, we must say that the role of the public bank is not and should be not to compete with the private sector financial institution. Public banks can operate in a complementary way with the private sector to fund the projects that the private bank refuses to fund. A characteristic example is the business that fall in the hands of workers, the companies that have made a cooperative form, those that the private financial institution consider as risky borrowers. We must not forget that refusing to fund the aforementioned types of company also relieves in part a dialogical differentiation and disagreement. At the same time, public banks may fund states as much less cost than today. Consequently, they might play a leading role in managing the debt and breaking the vicious cycle of associated public debts and banks. Third, public banks are not as effective as the private ones. As we already mentioned in several points above, public banks must have a different role than the private one. Their goal is neither to gain profit nor to satisfy the shareholding state. So, it should not make a difference if they reach high profits and significantly high financial ratios like return on equity or return on investment. Therefore, the use of financial ratio is not the proper means to prove the efficiency of the public banks. Therefore, public banks are used by political leaderships. Intervention from political leaders doesn't. In many cases and in many countries, politicians pressed either for employing particular employees or for getting loans of friendly business interests. However, most examples of bad banks management have been confirmed in private credit institutions, especially the most important ones. If I remember correctly, I think I do, the names Bear Stearns, Lehman Brothers, Citigroup, Royal Bank of Scotland, and others have nothing to do with state banks. However, to reduce the existing risk of political intervention, there must be an institutional legal establishment that will specify the transparent modus operandi and method of decision making on the one hand, and on the other hand, that will allow for social control. It is only through such procedure that we may ensure and guarantee that the operation of the public bank will be unhindered and that the aforementioned either winning with the state authority will be avoided. Conclusions. My suggestions to the government, especially the progressive ones, would be to promote the banking system differentiated role in its entirety throughout Europe. First goal would be to change ECB status. ECB's goals should also compromise the dimension of development and the unemployment rate. Second goal would be to make the last resort for all the member states of the Eurozone without conditionality. ECB change of role and the wrapping up of the banking union may help overcome the fragmentation in the European banking sector, converge interest rates differences, and historical liquidity. Other prerequisites for trust restitution are to create a deposit guarantee fund, to abandon any plans for future bail-ins, to increase ESM funds, to separate retail from investment banking, and to specify each bank allowed size As to the GDP of the country, it is based and conducts business. In a national level, governments should endorse the idea of having at least one banking retail bank, a public banking pillar, to create healthy competition, and a development bank that we accepted from the institutionalized standards of capital adequacy in order to be used as the basic tool to fund the economy and to achieve positive growth. What remains to be seen is the government intention to move to that direction. Thank you.
Thank you very much, Dimitris, and we will continue with Mick's presentation.
Okay, well, comrades, I'm going to deal with the aspect of debt and default. And whereas it seems to me that you have quite a coherent and well-argued case for the socialisation of the banking system, this is really quite a preliminary introduction to a discussion about this aspect of it. But the crisis has left behind it a mountain of debt. That debt is household debt, it is corporate debt, and it is the debt of whole countries. I'm particularly concerned with the question of sovereign debt, the crisis of sovereign debt, because it has been a major lever of the impoverishment of people, particularly in the peripheral countries of the European Union, but also all over the world. Michael Roberts told you about an innovation of British capitalism, I don't think it's made it here, called payday loans, where if you run short of money before your next payday, you can borrow money from companies such as Wonga. The only problem is that the interest rates are 2,000% a year, and that is in microscopic writing on the contract. Now, if you are in a job, you might just be able to pay off the interest when you get your next paycheck. It's still exorbitant, it's still usury, but you might be able to pay it. But if you lose your job, you just fall behind for any reason, then you are completely lost with an interest rate of 2,000%. And that is basically the situation that a lot of less developed countries have been in for generations. There is a huge amount of academic literature about the plight of less developed countries, and one of the major levers for impoverishing those countries is the question of debt. I'm going to give you the example of Egypt. According to a World Bank report, World Development, between 2000 and 2009, Egypt, where, as you probably know, more than half the population live on less than $2 a day, was paid 3.4 more in interest to its creditors than it received from them. So you think that when you're borrowing money, it's poor countries that borrow from rich countries. But in effect, the transfer is the other way. The poor countries are giving money to the rich countries who have nominally lent them money. And despite the fact that they repaid 24.6 billion over this period, the debt burden grew by 15%. There's nothing new about that. Here's a quote from 100 years ago. It should be clear now that the transaction between European loan capital and European industrial capital are based upon relations which are extremely rational and sound for the accumulation of capital, although they seem absurd to the occasional observer, such as us, because this loan capital just pays for orders from Egypt on the interest of one loan is paid out of a new one. That quote is from a book called The Accumulation of Capital by Rosa Luxemburg. She wrote a very good chapter on international loans, chapter 20, and that's what she described was happening in Egypt 100 years ago, and it's still happening. And in fact, what happened in 1882 in Egypt is that the Egyptian people woke up to find out that their country had been literally occupied by British troops. The whole country had been grabbed because they hadn't paid sufficient debts in the view of the British banking interests. So that process is still going on. What is new, and even worse, is that countries like Greece, which we might accept had escaped that sort of fate, now look to be being pushed down this very deep hole from which it is not possible to escape. This hole created by enormous debt where you just pay interest upon interest. I think it's also worth asking the question of where this debt comes from. I'm going to come on to the question of default a bit later on, but one of the biggest default, as far as I know, in the history of the world was the 2001 default of the Argentinian country. Now, where did their debts come from? They defaulted on, I think, 95 billion, it's generally reckoned, dollars. It is controversial, but quite a lot of money anyway. They defaulted on a lot of money. And one of the legitimate questions that you might ask if you're an Argentinian citizen is, how did we get 95 billion in debt? And of course, a lot of the governments of Argentina in the 1970s, 1980s, right through to the 1990s, were not elected by the Argentinian people. And on the contrary, what they were doing was taking Argentinian citizens and dropping them down cooling towers or power stations, or tying them hand and foot and throwing them into the South Atlantic from helicopters and aeroplanes. And I think it would be quite a legitimate question, if you're an Argentinian, to say, well, why should we pay debts for this sort of thing? That was also the case with Russia before the revolution. Not just the Bolsheviks, but all the Russian revolutionaries, the social revolutionaries and everyone else, they all went on speaking tours around Europe, and they said, look, don't lend money to the Tsar. The Tsar is a butcher of his own people. If you lend money to the Tsar, we will not pay those bills when we get in. And they didn't. And they actually defaulted. I think Russia defaulted for about 75 years on the debts. And indeed, it is a legit question, why should you pay debts of the Tsar, which he was borrowing to repress his own people? There are more complicated or nuanced cases of the same thing about odious debt. I hope I'm right about this, but as I understand it, Greece bought a submarine from Germany. I don't know why Greece wants us.
Not one, I think 7 or 8.
Okay. But I'm not sure why Greece wants submarines anyway, but I'm sure that if you do want a submarine, it's best to have one that can swim straight. Whereas the peculiarity of the submarines that they bought from Germany was that they list consistently to the left, which means they're fairly useless. And I think that...
30 is to the left, so...
Right, I think that if you're a Greek citizen, you might well suspect that money had passed hands between a Greek official and a German company as a result of that, which resulted in that trade, and that you might be entitled to say, you're not having it, we're not paying for this. So the question of odious debt is an important one as well, because how much odious debt is out there? I suspect most of it, but that's just a guess. But I mean, I think it is a matter of better countries actually setting up audits on the debts. Why have they been occurred? Who incurred them? And looking at it from that point of view of repudiating. The problem is that the creditor countries are going to say, no, it's you bought it, you're a sucker, so you've got to pay for it afterwards. And there's going to be an argument about that. But I think that is a thing that should be put on the table. Another thing that should be put on the table is it may sound paradoxical, but in the bankruptcy of individual capitalists is actually a condition for the continuation of the capitalist system. Marx called this process the destruction of capital, which he saw as a healing process where obsolete and obsolescent capitals are destroyed, there are fire sales of their assets, and this, in a crisis, that prepares the way for a renewed development of the capitalist system. And any capitalist country has to have a system of bankruptcy. A means of saying, well, this capital is no more. You can't claim any more from this. But of course you don't have that with nation states. And that is a big problem. Nation state, you can't say, this nation state consisting of 30 odd million people, in the case of Argentina, is bankrupt, and we can forgive them their debts or forget about their debts. Countries don't do that, and that is a big problem. Now, let's have a look at Greece. One of the reasons I wanted to speak before Greece is because obviously Demetrius knows more about the place than I do. But as I understand it, in Greece, if you look at their deficit, their debt with other countries, they now have actually got what is called a primary surplus for 2013, which means to say that they would have a surplus if they weren't paying so much interest. But unfortunately they are. And what we have in Greece has English law imposed on it, and we have this weird expression, an escrow account. English law apparently is the best law there is for screwing debtors to the floor. And that seems to be why it's been imposed upon the unfortunate Greek people. But an escrow account means that basically that money comes in and goes out without even touching the sides on the way down. That all the money that you get just automatically goes out to pay interest. That's the first thing. It's much more important than keeping the hospitals going or anything like that, keeping the welfare state going, anything like that. So that's the situation there. And a second problem that they have is that you can't actually devalue if you're a member of the euro. So how do you become competitive? Well, by wages and prices going down. And that's an extremely painful process. It's called deflation. And that has been going on. Wages have collapsed for millions of Greek people. Prices are actually going down. And the theory is that however painful, eventually this will make Greece competitive. But the trouble is that when wages and prices are going down, there's one thing that's not going down, and that's the monetary price of your debt. So it actually makes it worse for you. That deflation, as an economist called Irving Fisher worked out in the 1930s, actually makes debts more and more unpayable. And that is the situation that the Greeks are confronted with, and it seems inevitable that there will actually be a third bailout of Greece sometime this year. Bearing in mind that, as the point was made repeatedly, it's not actually the Greek people that are being bailed out, it's the banks that have incautiously lent money to them that are actually being bailed out, and that's what the European Union authorities are concerned about. Now, so we've got all these reasons why people can't and won't pay international debts. So I'm going to look at the situation of sovereign debt defaults. And I think the best book on that is a book by Reinhardt and Rogoff called This Time is Different. These people are severe neoclassical economists. Kenneth Rogoff was actually the chief economist of the International Monetary Fund, and he had a few goes at Stiglitz, who was at the World Bank at the same time. Stiglitz was kind of the good guy, Rogoff was the bad guy, defending the neoclassical orthodoxy. But Rogoff's book, Reinhardt and Rogoff's book, I'm not talking about the ideological basis of it, I'm talking about the factual basis of it, because it is, for modern era, it's a definitive book on the amount of defaults. And they trace defaults back to 1340, and they do hundreds and hundreds of defaults. So you might think defaults, well, countries defaulting on their debts, that's weird and unusual, and we've never heard of it. But I couldn't bring the book here, but I printed out some stuff from Wikipedia, which is based on their research. It is from Reinhardt and Rogoff. And there's Africa. Algeria to Zimbabwe have all defaulted at one time or another. Nigeria, which is one of the top giants of the African continent economically, has defaulted 5 times since independence in 1960. America's, again, we go from Antigua to Venezuela. Venezuela's got a list as long as your arm of times when it defaulted, particularly during the 19th century. Then we've got Asia, and we've got Europe from Albania to Yugoslavia. So it seems, if you were to just read this, that default is normal. Default is the norm. At one time or another, all countries default. I think they start with 1340, and the defaulting country is England. And I think they probably enjoyed that, the idea that this really responsible creditor country, Britain, actually started off as the subprime of the Middle Ages. That Edward III went on some expensive wars, decided not to pay some Florentine bankers, and the poor old bankers went bust in the 1340s. Apparently Philip II, at the height of the Spanish Empire in the 16th century, defaulted several times over that period. The French kings had a novel way of dealing with their debts. They executed their creditors from time to time. I think Voltaire would say, pour encourager les autres, to encourage the others. But anyway, default is absolutely standard. It's not quite as exceptional as you might think. The other thing that Reinhardt and Rogoff say is that there is a connection with the banking crisis. I'm not suggesting that countries or the rulers of countries just irresponsibly wake up one morning and think, let's default. We can't be bothered to pay our debts anymore. They get into crises. And in particular, there's a close connection with banking crises. Now, I said this is a preliminary discussion. What sort of defaults? There are what is called conciliatory defaults. There was a partial default in Greece in 2012 in the sense there was some debt forgiveness. Unfortunately, that debt forgiveness didn't help the Greek people at all. It was absolutely minor. But they did come to an agreement that, yes, we have to kiss goodbye to our money. We will not get our money back, or at least that bit of our money back. But then there are unilateral defaults where countries just decide they're not going to pay. One of the countries that did this to Britain was the state of Mississippi, and 7 other states in 1840 just decided they weren't going to pay anymore. The Republic of Texas was included. This was before it became part of the USA. And there were warships, apparently, seen off the coast of the Mississippi, British warships, but they decided they weren't actually going to invade the whole bloody place, so they would have to accept that they would not see their money ever again. Russia defaulted in 1917, China defaulted. Greece has been in default for at least half of its history as a modern state since the 1820s, and that is, they have got away with it. And what we need to talk about, and I'm not going to give you the answers because there aren't the answers, you really have to think about this. I'm not going to suggest that you demand that Slovenia defaults from its debts, but I do think that, for instance, in the case of Greece, there will be a default at some stage. I think that this debt burden is insupportable. I'm not advocating that the Greeks just go out there and say to hell with you, we're not paying a penny anymore, but I think that that's going to come to it at some point. An additional problem is that you have what is called vulture funds. The fact that you don't have a bankruptcy system means that in the case of Argentina, the vast majority of the creditors agreed to accept a couple of pence on each dollar of the bonds that they had. But then you get these people, the vultures. And these are American right-wing billionaires, by and large, who go around buying up these junk bonds for next to nothing. And then they went to a court, quite obscure commercial court in New York, and they got a judgment that they needed 100 cents in the dollar back on their bonds. And they started to pursue Argentina through the courts on this. And because the USA is a global superpower, they did actually impound an Argentinian ship in Ghana. They got a Ghanaian court to seize this ship as property that might guarantee their debt in some way. And of course, people who like war on one are doing their nut about this kind of thing, because this will make economic development, which is dependent on getting the debt down to manageable levels, absolutely impossible. But that's, I'm afraid, the nature of the market. I think it is worth going on about the Argentinian case, because the big argument about defaulting as a country is that you'll get locked out of capital markets. People have lent you money and you said, we're not paying you back. So obviously, the argument goes, they're not going to lend you any more money. Actually, that's not always the case. That wasn't the case in Argentina. Argentina's quite a prosperous country. It has a very prosperous agricultural sector in any case. And they defaulted in 2001, and within a couple of years, they were actually back in world trade, and people were lending them money once again. So there are lots of things to think about national defaults, and I'm just raising this as a very introductory discussion about the pros and cons, the problems that are involved. But I think if you're even talking about repudiating the debt of a country, you get the threat of capital flight. Now, capital flight doesn't necessarily mean that all the rich people will run away, although it can mean that. The rich people might decide that if you're going to cancel the debts, make sure that poor people are all right, stop giving all the money to the rich and the banks, then they might decide, well, this country is not for me, I'm out of here. But that's not necessarily the sole form of capital flight. It might be the case that if traders think that you're going to cancel your debt, that you're going to cancel your debts, they won't just issue ordinary credits for quite day-to-day trading transactions. That your trade will gum up as a result of the threat. So you will need capital controls. Now, we had an era after the Second World War that I'm going to call the Bretton Woods era, where you had fixed exchange rates, where, by the way, we had much higher growth rates, generally speaking, than we've had since, between 45 and 73, is generally regarded as the golden era of capitalism. At least in the advanced capitalist countries, you had relatively full employment and steadily rising living standards. The capitalists could afford to give you a welfare state, or at least we made sure they gave us a welfare state. And we had enough power to do that after the Second World War. And everything seemed hunky-dory. And then the Bretton Woods system was based on universal controls on capital movements. For instance, in the case of Britain, you could not take more than 50 quid out of the country before the 1970s, which really wasn't very much.
You
to
not
go
as
on
an
the basic-
individual, but your banks did.
Hmm?
Your banks did. You did not do as individuals, but
The
the
banks,
City of London was open very much in the 50s.
yes,
so-
yes, that's the point. Capital individuals can't dodge capital controls. Banks have the means of doing it. So that means that the only way you can make capital controls effective is by taking over the banks, which is where we started. You have, if you're talking about debt default, then you're going to end up with capital controls, and you're going to end up with socialisation of the banks. But just on that, capital controls were eliminated in the era since then, which has been an era of slower growth, this neoliberal era, if that's what you want to call it. It's been an era of slower growth. It's been an era where vast movements of money capital have been a characteristic. Obviously, well, I say obviously, it's obvious to me, the first person who eliminated capital controls was Margaret Thatcher in 1979. And this was an act of complete dogmatism. She went in and she said, not only are you going to eliminate capital control, she also told the civil servants to burn all the documentation. Because any civil servant will think, hang on, we'll keep these just in case something happens in the next decade or so. And she said, no, this is going to be final, definitive. You know, you'll burn the documentation on capital control, so we're never able to do it again. But we still have the case where China has quite severe exchange controls. India does, which paradoxically they keep from the time of colonial rule by Britain. So that's their exchange controls. Malaysia reintroduced exchange controls after the Far East crisis of 1997. Iceland, for a period of time after its crisis, brought back exchange controls, and of course Cyprus has been allowed, for an exception, for a short period of time, by the EU to have capital controls, despite the fact that that goes against the holy ghost of free movement of capital, which is one of the bases of the European Union. Okay, so you're right. When we talk about debt repudiation, and I emphasise again that I'm not coming here and just saying irresponsibly, just to hell with your debts, just tell the rest of the world you're not paying anymore, and that's all there is to it. But we do live in desperate times, and that means there will be desperate measures taken by various countries at various times. This is bound to come on the agenda. Now, in the meantime, let's have a look at European Union solutions. The situation in the European Union is that monetary policy is determined by the European Central Bank. It's out of the hands of national governments. Fiscal policy is jealously guarded by individual nation states. There's a contradiction there, that is part of the faulty architecture of the single currency. But I think the basic problem all the way through, when we go through all the technicalities, is that the European Union is not a commonwealth of citizens of Europe. It is a congery of nation states that are all trying to make sure that they're all right at the expense of other nation states. And in particular, we have a sort of semi-dominant nation state in Germany, which vetoes quite often measures that might be in the interest of the peripheral countries, which are suffering worse than the others. For instance, the first one is the question of Eurobonds, which also Demetrius raised. And the point about Eurobonds is that at one time, Greece was paying enormous rates of interest for their government borrowing, whereas Germany was you were over 20% at one time, weren't you?
Yes.
Yeah. They were paying more than 20% a year on government bonds, whereas Germany and other countries would be borrowing at 2%. The idea was, why don't we have just one Eurobond, where presumably the interest rate would gravitate towards the German level rather than the Greek level, because you would have the whole of the the credit of the European Union lined up behind you, and that will be the way to do it. Well, the problem is that the Germans, and I'm not talking about Philip, I'm talking about Angela and people like that, don't trust the Greek government. They don't trust, and their idea is, we want strict controls. We don't want you being a spendthrift and running out, spending lots of money, and then we end up picking up the bill. And that has been the problem with Eurobonds, and that's the problem with a lot of these things as well. We have something that's ingrained within the European Union called the Fiscal Compact. And it is a classic of neoliberal ideas. The idea is that everyone has got to control their government spending. And this is based on a really fundamentally mistaken idea that there are two sorts of governments in the world. There are spendthrift governments, probably left of centre governments, and then there, on the other hand, there are conservative governments who cut their coats according to their cloths. And what is important is that everyone tries to save their money, not waste their money on hospitals and schools and stuff like that, but they save their money, don't run deficits, don't run debts. And that is fundamentally mistaken, because in Britain we had a government debt about 40% of national income before 2008, now it's over 80%. And they ballooned everywhere, and it's not because we, the British people, suddenly ran out and spent money on social services. It's because we bailed out the banks, and it's because the economy crashed. In other words, the government deficits and debts are dependent on the state of the trade cycle. And that is particularly the case when you spend all your money on bailing out the banks. That makes the situation that much worse. So in a situation like that, you get, it's not a matter of cautious conservative governments versus spendthrift governments, it's a matter of all governments, whatever political persuasion. George W. Bush, right-wing Republican, and Gordon Brown, a middle-of-the-road social democrat in Britain, they both saw their government deficits and debts explode in the wake of the 2008 crisis. So that's just nonsense. Then we have the long-term refinancing option. And again, this is quite promising when you look at it. Because what it means is the European Central Bank should be able to act, in effect, as a lender of last resort, like a national bank does, like the Bank of England does. The idea is when there's a crisis, the Bank of England will open its chequebook and spend as much as it's needed in order to bail out the banks. And hopefully, the mere presence of the Bank of England is so intimidating and it's so calming to the markets that the crisis will be overcome. And that was a theory that was developed in the 19th century by a bloke called Bagot, and that's a core idea. The role of a central bank is a lender of last resort. When there comes a crisis, they will go out there and save the banks. And what's the point of them otherwise? And the European Central Bank would like to do that, but in effect, they're being held back by the constitution of the European Union. Then we have the European Security Mechanism, which replaced something else called the European Financial Security, is it fund or facility? Facility. Now, the ESM is a permanent thing, unlike the EFSF. That's good because the EFSF only emerged because the European Union said, hey, we've got a crisis, let's invent something to deal with the crisis. They've now worked out, we might have another crisis sometime, let's have a mechanism permanently in place. So that's a step forward. The step back is there's actually less money in the ESM than there was, which we have now, than there was in the preceding EFSF. And the idea in both of these is that I think the expression was used in the financial press, it's a big bazooka. You know, they go out there and they've got so much money that they can see off the speculators. The speculators will say, we go somewhere and make easier money and just run away from the situation. And the fact is that this is not a big bazooka. It's more like a pea shooter. It's not enough to actually deal with the problems. So, I think, just to sum up, the debt is the primary lever which is grinding down living standards that will be identified as such. Go back to the subject of Greece. There was an economist who, I think, lives in Britain, Kostas Lapavitsas, that is obviously of Greek extraction, was arguing that what the Greeks need to do is Grexit. This is another word that was invented by the British financial press, which means they should exit from the Eurozone, that they should reintroduce the drachma. Now, I think most commentators know that the drachma would immediately fall to at least, at best, 50% of the value of the euro, which means that Greek goods would be very cheap. You could go on a Greek holiday for next to nothing with the new drachmas. The downside is the debts are still contracted in euros, and so they would have to earn twice as much in new drachmas, if that's what we're going to call it, to actually pay off their euro debts. So that's not really very satisfactory. I think, I'm told Lapavitsas has kind of climbed down on that position a bit, but in my opinion, in any case, that is misconceived, because I think I'm right in saying that if you're a Greek person, you don't say, my problem is the euro. You say, my problem is this impossible burden of debt, and the fact that we're paying all this money, we're not getting anything back, we're destroying what of a welfare state we had to do this, and therefore the problem is elimination of the debt. So I think, just to finalise, yes, the debt repudiation will come. I'm not saying it will come in Greece next year, I'm not making any firm predictions on that. But debt repudiation is part of the inevitable process of development in a capitalist system, where you get crises and where you get winners and losers, and where the losers are lumbered with impossible burdens of debt. And I think that we have to seriously think about them. And Slovenia is a peripheral country within the European Union. It's not in such a desperate position as Greece is. But I think we have to have a serious discussion about the issue of debt repudiation, because I think it is going to happen at some point.
Yes, thank you very much. A lot of interesting and important issues have been raised by both speakers. Right now, unfortunately, we only have 25 more minutes for the debate, but I think we will be able to compensate for that in the next workshop at 3:30. But nevertheless, if there are any questions for the speakers, please.
Well, actually, I mean, it was such a broad range. I could come up with like 25 points, or areas, so to say, and having 10 points in every area. So, perhaps first of all, on Dimitri's presentation, I wasn't sure whether I got it right in all the aspects. So, one thing I heard was that you, of course, saw the shifting paradigm, or some, well, relaxation in the policy of the ECB from Trichet to Draghi. And that, of course, this announcement of an OMT obviously had some positive results for how long ever it's going to last. So would you generally say that the ECB does its best as in the framework of its mandate is possible by now? And if yes, I mean, you have mentioned what should be added to the mandate in terms of employment and development. Would you see some common ground? I mean, certainly not in Germany, but there are some other countries in the Eurozones to talk about the issue of a more pragmatic approach, also in the terms of state financing. So what we, as Die Linke in Germany, argued was there is no human serious reason why you could not allow countries to have the same access to a central bank as a commercial bank has. So we are not necessarily saying the ECB should just print money and give it to every government for free. But if they are giving it for free to the banks, why they should not also give it for free to the governments? And when in fact it comes to some point of inflation, of course we could wonder whether rates have to be getting up, and then also rates for governments with access to the ECB would get up. That an idea of something like that, as a rather emergency access to central bank financing, would be something that we could reach a consensus, not just with people in Greece, but also in your contact with other of the affected crisis countries. And then secondly, on regulation, you didn't explicitly label it as the Liikanen Commission, but you referred to the idea of separating retail banking from investment banking. Do you think that this is the right way to go? So this traditional system of having separate types of banking there, just to give you the position that we have developed is, we're not generally saying no. Of course it must have this separation between retail banking and investment banking, but this is only then to, in the next step, wind down the whole investment banking. So at the end we would not have like two different separate pillars of the both, but just one remaining, because investment banking as such, as a whole, would be banned by regulatory instruments, etc. Perhaps so far just from you, and then later I can come back on you.
For your first question, I think that the ECB have a lot of things to do. I don't think that they've made everything. For example, I remember the last reference conference of Draghi, when they mentioned to him that we have an inflation problem, a possible inflation problem in Europe. He said, okay, we'll see about it. It's a wait and see policy. For some, I believe that he can do a lot of things. He can do a lot of things. Of course, I agree with you that we have to change the state and to give the dimension of unemployment and growth rate for me. Now we have a unique case in central bank history that they only care about a monetary data. They all care about price stability, not something else. Now about the common ground. Perhaps in the periphery countries like Spain or Portugal, they possibly want something same as in Greece for the ECB. I don't know what if when it happened. I don't know. Perhaps if because as you know, Greece as a political party, Syriza, we're trying to change the policy. We're trying to get the administration. Perhaps if we get administration, the thing will be more easier for us to struggle for a change. I don't know if it's the right time. For example, our government accept everything Troika give to him, give to them, everything. They said that, okay, we're under negotiation, but it's left to see the same scheme every time. We have seen this 15 times, same thing. That we are under negotiation, and suddenly on Sunday night, they have an agreement. Negotiation, suddenly have an agreement. So, if we need a change, I think that first of all we need a political change. So to get the power to force for something else, and for ECB and for Commission and etc. For example, I have an opinion about Commission that if we want the commissioners, we must vote for them, not the government to choose one or two and say, okay, for the finance, we give Mr. Ren, for example, now, but he's not, he voted. He was elected by, he was chosen by his government. Okay. So about the second one, I have some solution in my mind that I wrote it down about the separation of the banking. I think that the banking must be divided to retail and investment because of the crisis of 2008. I think that if we have in the near future the same crisis, I don't know how the system will react. So one of the solutions I suggest is to separate different things. I don't think that it's going to happen in the near future. Yes, because the big banks and made a lot of lobbying, as you know, and they don't want it because the 85% of their profitability is coming from this.
Yeah.
So, not from retail banking, but investment banking. So how we can convince them to stop, take profit from the markets, and to have their mind only in classical banking, okay, loans and deposits? I don't think so. So, for me, we have the same solution, the same process. First, the political change, and after all the other changes we want in the banking sector, etc. Okay. This is
Okay. Are there any other questions?
I have another question.
Robert.
No, you go ahead.
Yes.
Well, perhaps I'm gonna talk a little bit about public debts. I'm in a very particular situation because I used to be very involved in the third world debt movement in the 90s and the early 2000s, and then I ended up with our parliamentary group shifting the perspective from outside the parliament into inside, and now from third world or emerging countries debt and the Southeast Asian crisis and areas like that into Europe. And of course we had all this discussion on state insolvency regulations, the SDRM, the sovereign debt restructuring mechanism discussion with the IMF in I think 2001. A lot of these things come back now that we were before talking as a model for Argentina or for Indonesia, and that now comes back as to be also applied to so-called the crisis countries in Europe. And I think we must make some differences between these different situations. I'm not saying that we must not learn from the different instances, but first of all, the major problem of developing and emerging countries is foreign debt. So not debt in their domestic currency. But in the Eurozone, we are somewhere in between. It is not actually a domestic currency because a country with domestic debt problems normally do not have debt problems, they just print money. Because printing money is bad, but everything else is worse. So going on default in your domestic country is actually nothing that normally happens. As far as I remember this article of Rogoff and Reinhardt, that was normally cases where they repudiated for legitimacy reasons or for just running out of funds in times when there was no such thing as a central bank. For example, when Edward III with the Florentine bankers, there was not such thing as the Bank of England. But in only the more newer cases, as far as I remember, it were only cases involving foreign currency, so where the debtor had no chance to print the money himself. Because I would say whenever you come in such a situation, it's always cheaper to print money and to accept inflation rather than to go on default. But Greece do not have this opportunity, though it is its domestic currency, because it does not have access to the European Central Bank. That was part of the proposal that I was making, that at least in emergency cases, you should have access to your national or monetary union central bank to prevent that from happening. If you don't, then still you have to differentiate between what is actually the level of the debt burden in terms of payments, and what is the burden in terms of the conditions attached. And so I would already argue for a lot of Southern Latin American countries that even then the neoliberal recipes received by the IMF in the 80s were, in terms of destroying the economy, at least as relevant as the pure resource transfer that happened back from south to north. I mean, in the long term, it's very normal in the credit system that you have a transfer from the debtor to the creditor. That's the original idea of having credit, that you pay rent. And interest payments are, and that's so far a rent of the owner who afterwards owns more. That's certainly not just, but that's capitalism as it is. So, therefore I would argue even in a lot of developing countries, there was more ruined by the policies applied and imposed from the external creditors than by the sheer burden of debt itself. It differs in some countries, but particularly with the euro crisis, I would argue very much so, and in the Greek instance in particular. I would say the Troika policy, the austerity measures, have mainly caused the economy to shrink by 1/4, and only as a result of that, the burden of debt has skyrocketed so high as proportionate to GDP that it is unbearable now. But still, if you compare the figures of what you pay to service these debts, it's not so much higher for many crisis countries now than it was 15 years ago. So I think apart from Ireland and Portugal, all the so-called crisis countries now pay less in debt service than they did in the late 90s. So not only Germany is far better off because of the low level of interest rates, but so is France, so is Spain, so is Italy. They all pay far less as proportionate of their state revenues now than they did 15 years ago. And at that time we were not talking about a debt crisis in these countries. Because everyone knew if it would get more complicated, they would have access to their national central banks and just print money and get out of the mess. And it is only this particular construction with the Eurozone without access to central bank money in an emergency that makes you so vulnerable to capital markets to speculate against you. And so far our argument, beyond in a short-term sense having access to ECB money, would therefore be, if you want to have a currency union, you must also share the risks of your public debts. Thereby we need to unify them in the terms of Eurobonds. So by now the average interest rate that Greece is paying is probably higher than what we would achieve if we had Eurobonds. I mean, it is still not so high because it's basically public creditors. If it were with what we have experienced in 2010 when the spreads went to 20%, of course, then we would have saw the default in 2011 probably. But with the idea of sharing the responsibility, I think it would be a decent, well, solution is not the right word to say, but if we abandon austerity policies and replace it by, I think some conditionality would be okay. So I think in Greece there would be some need for taxation system, particularly for the rich people. And in Germany there would be some binding rules to get down from our surplus model to rebalance our economy. Then I think combine that with Eurobonds would mainly solve the problem. Insofar I would not argue so much about the sheer size of the debt in the European case as different from some other countries. I think perhaps in the Greek case one should talk again about a second at least an audit process where instances like what you have talked about, these German submarines, you know, it's not just this only one, and there are also other areas where, you know, it was golden handshakes from both sides, and so it is very important in terms of democratization, the whole process, to talk about this publicly. Therefore, I very much agree with all these audit campaigns in the countries. But of course, we must be also very sure that it will certainly be a difference if you have a formally democratically legitimized government that decided to bail out its own banks, that cannot be as easily called illegitimate as we would do with some, you know, South African apartheid time debt incurred by Taliban's delivering weapons to kill their own people. You know, there's a big difference in that, even though there are a lot of officials involved in kickbacks, etc., in dealing today. That's not the point in not accepting that, but still it's a huge difference. And whenever it comes to, you know, us being part of a government, we will certainly put the money in some hospitals and other things, and I don't want to be blamed for having basically incurred illegitimate loans because they were not 20 years after considered as to be macroeconomically and microeconomically sound and haven't paid off, so to say. Yeah? So it's a tricky thing. Also in Germany, in the Linke, we are very deep in the discussion about this issue of how far to go for the audit and to question that as such. But the more we do, of course, it is also the more difficult to actually have access to credit markets. And first of all, I would like to rather take the money from the rich. But even then we do that, there still might be some public investment necessary that could seriously funded by private means, by Eurobonds, if we manage to invest it in the proper challenges that we face as societies, like climate change, like energy diversification, overcoming the atomic or nuclear age of power production, things like that. And this is all very costly. And so, yeah. There was one last thing I wanted to make, but I think I forgot it, and I've talked too long anyway.
Can I ask something? It might be stupid, but how about write-off inside EU of the debt, between states that goes into the sovereign debt?
You
Is
mean
that an option or?
between the different economies or between the public institutions?
Either. But yeah, I guess public institutions.
Right.
Or forcing the big banks that, have some, over which some leverage is being had.
I'm not sure that I correctly understood your question. It seems to me you are asking whether there are countries financing other countries, because that is a possibility. It is not a possibility within Europe. At least I think so. For instance, Russia gave credits to Serbia. Russia as a state, its treasury. And that was okay, as far as I'm concerned. But it was on good terms and stuff like that. But for instance, the creditor of Slovenia is the creditors of Slovenia, for instance, are first of all residents of Slovenia, the banks resident in Slovenia, and then of course investors who are buying the euro bonds and bonds issued in dollars. And those investors are investment funds, pension funds, and some of the commercial banks. In times of Yugoslavia, for instance, socialist Yugoslavia, who was also one of the countries hit by the debt crisis in the 80s, and in fact that debt was never repudiated, at least the part that was left for Slovenia to repay, and it was repaid every cent. None of it was written off, like in case of Poland and some other East European countries. But still, it was not a big problem. But to return, Yugoslavia was, the credit that came to Yugoslavia, the loans were in the first phase, let's say until early 70s, it was by international institutions such as International Monetary Fund, World Bank, and institutions like that, and only afterwards by commercial banks. So I don't know if I understood your question correctly, but there are no creditor-debtor relations between governments except in cases of rescue packages like in Greece or in Portugal, where countries, including Slovenia, EU and member states, are guaranteeing for the debt or actually giving credit to Greece.
For example, in Greece, because there's a misunderstanding, the first loan agreement was an agreement between Greece and the Euro states, with the exception of KfW. All the other, the second loan agreement was between countries. It was between Greece and the EFSF, and now it's ESM. So, when the program was finished in 2016, the first quarter of 2016, we'll have 250 billion euros from states, from IMF and from EFSF. To IMF will be around 50 billion, and all the other, the 200 billion will be at the euro area, let's say. But EFSF, how the mechanism of the EFSF is, or ESM, it issued bonds every month, every week. So they have private investors, not state as investor, but private investor. It's like the issue we see every day worldwide. So it's something different. But if we see that if we add European banks or states, I think that almost 90% is between Euro members. I don't know. It's less.
Yeah, but not governments, but economies.
Yes, economies, yes. Banks,
main-
etc. Yes.
Yes.
Banks, states, etc. Institutions, pension funds, everything. Almost 90, I think so.
Well, the point is, we don't actually know, because the money and the liabilities are on the market, and whoever has them has probably some registration in some electronic account somewhere, but there is no way of registering that on some kind of an international debt surveillance authority or something, just to know where actually your state debt is hanging around. You just don't know. And therefore you don't know what banks may suffer. Is it mainly your domestic banking sector that is going to be bankrupt? Or is it rather, or at least to the same level, Cyprus that is going per se bankrupt if you are just doing a private sector involvement in Greece? And I mean, the stupid thing about Cyprus was, of course, the negotiations and particularly the debt standstill and the capital controls would have been to immediately impose on the day that you have done the private sector involvement in Greece, because otherwise everyone knew Cyprus would go bankrupt in a couple of months, and all the international investors are gone then. And to be honest, it's not to be very smart to know that, and it's really it's really a waste of public money not to having kept the oligarchs actually in Cyprus to pay part of this private sector involvement, but it was mainly domestic people with far lower wealth status that actually bear the brunt, and that's certainly not what we would consider to be bail-in of the rich. Of course, some rich were taxed that way as well, but my general assumption is that haircuts are not a very targeted way of redistributing wealth from whatever private to whatever public sector. The more desirable way to do that is taxes, because then you know why you tax whom by what rate. Of course, the problem is that you have problems with really taxing the rich people because they have their taxation evasion schemes. But still there are a lot of possibilities where to improve in that respect. And so this is also a strong argument within our party, so whether to go for just, you know, the cancellation of debt and say thereby we really get the bad guys, and then in the end we just basically get the British and the Netherlands pension schemes, basically, because they are in the euro bond market to a large extent, and it's not so far Warren Buffett that we're going to hit. And it will be, finally we'll only know 20 years later when it comes public who actually lost how much, but then it's too late to rethink this idea.
For example, there's a new idea for how to break the vicious cycle between banks and debt. Loan agreements. What's a loan agreement? I am a bank, you are a state. I can give you a loan with fixed income, with fixed rate, so you don't need to issue bonds to cover your needs. It's something different. Because if you know how the banks works, they have the asset side and the liability side. If they want to cover the liability side, because for them deposits are liability and not assets, they have to cover it somehow. The most common thing is to buy bonds. Okay, so if I have a loan agreement as a state with a bank, as a state I do the money I want, and as a bank the loan is for them an asset. But for the same time, they don't need to find a high yield instrument if the things go wrong. It's something different. So I don't need to issue bonds. Banks also will have better ratios in NPLs and everything, because according to Basel III rules, the risk weight of the state is zero.
Yeah.
So it's something else. I remember that Professor Richard Werner suggested, yes, and also in Greece. And when our bankers heard about it, make a revolution. Why all these things? But it's something new that you have to find alternatives how to solve this problem, the problem, the financing problem. For me, it's good to hear something different.
Yeah.
So also, for example, there's a research analyst in IMF, Campo, whom I remember well. He has a plan, it's called Chicago Plan. don't know if you...
Well, they revisited it and applied
Yes.
it.
What did he say? That if we want to break against this cycle, we can give the money, the central bank, right to the banks as a reserve. So we create assets, we increase the asset side for them. So they don't need to cover the liability side in a hard way, trying to find out to give, for example, higher rates to the depositors. So there are new ideas, and I think that in Europe we have to discuss them, all these new ideas, and without have ideology problems, okay, let's say. My proposal is that we need an open-minded view to see what we can do.
Okay.
I agree, of course, with you. With this.
I'm sorry I have to interrupt this discussion, but I'm afraid we ran out of time, so we will continue with the next workshop.
Aha, okay. We can prolong for a few minutes, for at least 10 minutes, okay?
Okay, but then we can continue. Okay.
So, Draghi, you wanted to say something?
I presume the bond yield on the fixed rate loan agreements would be somewhat higher because
No, for example, in Greece, in 2010 we have if we can issue bonds, we issued bonds at the rate of 20. Today, if we want to issue bonds for 10 years, we have a rate of almost 7%. So it's too high for us. We get into the memorandum era with a rate, the last issue was at the rate of 6. So now if I want to make an issue to 7%. So if you have a loan agreement, and as I told you before, with risk weight 0, I can negotiate a rate, a lower rate than I could get from the markets. So I don't need the markets. Something new, something different. And it can give solution also to the banks, also to the states. Because we don't need the markets. We don't need the markets, as you know, they have volatility. If tomorrow a bond is something good, perhaps the next year it will be a disaster. I remember that. Yes, I remember that 3 days before Lehman collapsed, that their bonds were rated AAA. And in 3 days, they're gone. So, also, for example, in Europe, we need a European rating agency. I don't remember who mentioned this yesterday.
it's your proposal as well.
And now we are hostages from the same guys as we were before 5 years. And unfortunately, ECB wants the ratings. For example, if a firm, a private firm in Greece, issue a bond, as a bank you cannot give it to ECB to take the liquidity without rating. Rating from home for the same guys.
One remark in that respect. If we assume that really the worst thing about the debt is the condition to that, particularly in the euro context, then one must be really very lucky that Slovenia did not have to tap that source. Yeah. So when in last October or November there was the question of does Slovenia have to tap the ESM or not? I didn't follow it very closely at that time, but now looking back, I'm very, very lucky that he found a ways to prevent it, and that the government actually, I mean, if you would have a right-wing government, then it would have been so easy for them to just blame any of their bloody policies then on a troika and saying we're just going right through, taking the money and doing just a social devastation completely and blame all of that on the Troika, which is very easily and has happened frequently in developing countries. So in Brazil and some other countries, they did it very much like that, because it's far easier if you can blame it just on an external power that you don't like anyway. And so far, I think the public debt spent on recapitalizing the three banks rather than accessing the ESM was certainly, in the social sense, far more legitimate than anything else.
Well,
well, it's strange, but it differs from whatever angle you look at it.
well, it's controversial.
Yeah,
I would
absolutely.
say. See, well, my personal opinion would be, if there would be, if it were possible to make a kind of a Spanish type of arrangement, which meant only the funds for recapitalizing the banks, in terms of probably loans or probably loans to the Slovenian government by the fund, by the ESM. It was not then ESM, but let's say ESM. So in order to recapitalize the banks, those loans, the interest rates on those loans would have been much less than the interest rates on the bonds that Slovenian government issued in the late 2013 and early on this year. Because the interest rates in 2013 were almost 6%, so this is very high. But of course, to paraphrase the Spanish Prime Minister, Spain might not be Uganda, but Slovenia is. So I don't think that Slovenian government will be able to get an arrangement like the Spanish ones. Spain not officially included in Troika arrangement, with no memorandum, no particular conditions attached to the rescue package for the banks. Because in Slovenian case, it would probably be, of course, much harsher conditions, and in terms of austerity measures. So I would say the end result we will see. We will have to see what comes out of it, but certainly some sort of a Spanish scenario would probably be better than what we are at now. Now, it occurred to me that now that we are discussing these things that are not always quite clear and easily to, are not very easy to understand, to comprehend, I remember that Nick sent us some of his papers where he very well explained things like Eurobonds, what that would be, what is the problem with them in the eyes of their opponents, what would be the scenarios in terms of default and stuff like that. And I would recommend this if you are ready to give open access to those documents, okay? For the journalists, for instance, to take a look at it. There are short texts, but very, very up to what we are discussing here. Now, if I may, to that broader picture about. Now I'm venturing into an unfamiliar area, I must say, but about financial instruments, and this is what I was aiming at yesterday. You see, I don't think that the return to very classical and rudimentary financial instruments would be the final answer to our problems. I'm not saying that a good credit, a large credit with zero interest rate from China to Slovenia would not be helpful at the moment. Of course, it would be.
Have other problems.
Yeah, maybe. But of course, maybe there would be other terms. But you see, I just want to say that socialization of the banking sector should include socialization of the financial sector as such. And then all of these problems, cognitive or epistemological if you want, of knowing who has the debt, what kind of instruments are used and where, would become more transparent. Because we know that at the moment, the holders, the current holders of, let's say, German bonds are known because they get their payments every year or in 10 years. Of course, they change hands, but it is at the moment where their payment is due, the one who is entitled to get it is known. That's one thing. The second thing, we have Ministry of Finance, they have a balance sheet, and they know how much debt is external and how much debt is internal. Okay, these are statistical categories, not always useful and quite complicated, but still, we do have a general idea what debt is internal and external. So we also have to use not just the gross public debt data, because that does not tell us everything. We have to also know, let's say, net external debt, in order to be able to appreciate what happens. Because, for instance, in a country like Japan with the largest debt, the debt is domestic. So whatever you do, it is sort of a redistribution within the country. But not to go too far, I would just say socialization of the banking sector and of the financial sector would make the use of not only the conventional and traditional instruments, but also the new ones, such as we were discussing yesterday, like derivatives, also futures, options, swaps, which could be useful instruments of economic policy, more, let's say, not only transparent, but more coordinated as well. And that's why I think you should also try to include that in your agenda, in your program. Not only to rely on very rudimentary and traditional and simple instruments. You know?
Is there any final comments or final questions?
I think everyone wants their dinner, so I'll be very, very quick. To me, there's no reason whatsoever why there shouldn't be Eurobonds issued. No reason whatsoever in practical terms. There must be ways of stopping individual spendthrift countries from running out and betting the farm on something stupid. There must be a way of controlling national expenditures while allowing Eurobonds to reduce the interest burden upon those countries. But it's not going to happen. And you can go through one thing after another, which is extremely practical, it should be obvious, should be already happening. And I think we have to ask, is the European Union a neoliberal prison? Because it seems to be run by undemocratic people who are completely dogmatically committed to neoliberalism. As people have said, Trichet was completely comatose during the period when the crisis actually struck in 2008. Finally, Draghi wakes up a couple of years later, and the problem seems to be at bottom a political one rather than an economic one.
Sorry. Yeah, I agree that there is a general neoliberal thinking very much rooted also in the Commission. But I would still say the problem is not the Commission, the problem is some governments in this European Union. And so the solution to the Euro crisis is not to throw Greece out, but to throw Germany out, basically. And the same is with the EU. So if you have no chance to really counter the power of that devastating country, it's very difficult to end up somewhere with that whole construction. And the point is, so far Germany has always managed, whenever it comes to a deeper crisis, to shift the largest part of the brunt to somewhere else. I mean, we were so, not to say lucky, but the whole idea of running surpluses of 5 to 10% of our GDP, we thought would be over with the Euro crisis by falling sales of cars to the rest of Europe by 20% in 1 year. And they thought now it's gonna take up, that we are redirecting our whole economy to domestic needs, public investment, to get proper wage increase, etc. And nothing of that happened. So the whole problem ended up with Southern Europe, and Germany was off. And I'm very lucky to hear some advice in what we could do there to make better use of the next situation like that.
Well, I mean, it's of course an important question for the radical European left, or European left as a united group in the Euro Parliament and stuff like that. And I think there are two ways of answering the question that Mick posed. There are people probably who would say the European Union can be changed in the way we suggest, and then things would work out. And then there are people, and I tend to agree more with them, who would say no, because of the relation of forces between classes and states in Europe, this is simply not. I mean, this is simply not possible. So what you can do, for instance, there is a huge bloc, hegemonic bloc in Germany, including not only the upper classes, but also, I would say, the popular classes as well, who benefits from the situation as it is, and will not be moved in order to modify the situation into something that would be less opportunist for them. Whereas in a country like Greece, it could be imagined that you would have a coalition of popular classes and middle classes taking over the state power in order to have, for instance, a national bank that would do its central bank acting as a lender of the last resort, nationalized or coordinated economic stuff like that. So it is a matter of, let's say, what is more likely to happen. Could we, from the periphery, move this hegemonic bloc not only in Germany, but we are always not only in Germany, but in the northwestern part of Europe, or could we move our local relations of class powers? And I would say that the second one is much more likely, and all the revolutions have been in the periphery. Of course, history can always surprise us, hopefully for now.
I think that's a good way to finish, and we'll see each other at 3:30 on the next workshop.